Oh, okay. There we go. Does it let you guys know we're recording? Yes, you are awesome, Louis, definitely. All right, great, great, great. Now we are recording. Ready for a double header. Yeah, that's how it's gonna feel. I wake up in the morning, I'm gonna be like, why did I do this last night? But it's cool. I work for myself, so I'm gonna dock my own pay. Taven, what's up? How's everything, man? Good seeing you. Always happy to see you around, man. I know you're hungry for learning and you want to learn more. Um, I know you're definitely gonna get it. You're gonna be able to leverage this, and you won't have to have you won't have to take the same path. Your friends, take or will take. You know, so always happy to see you around, man. Let's get into it. All right, great. Actually, where is gotta pop out the chat. Yeah. All right, there we go. My friend Stacy is on tonight. Hey Stacy, what's up? How you doing, girl? I hope I teach pretty well enough to make you miss out on sleep because it's kind of late right now. So I hope I meet those standards. Put me in a pretty tight spot, Lewis. No, I'm kidding. All right. Let me. Yeah. That's old man sleep time, 10 o'clock. Um, I'll let you know. All right, fingers crossed. Ryan, what's up? How's everything, man? I got your message, by the way, Ryan. I know those days, man. Oh, like when they say the baby in the bathwater, I know those days, man. But hats off to you, being involved, to newborn and difficult, man. Yeah. Yeah, get some coffee, all right? Yeah, exactly. Get some coffee. That's what we need. At this point, I just need to eat the coffee beans as chips. I think that's what I need to do. Just munch on caffeine. I used to eat the Nestle powder out of the box. You just eat the instant coffee. Yeah. So I want to make sure that coffee's a part of the strategy. Yeah, exactly. Exactly. That's the bridge underwater, they don't know that it's coffee. That's all it is. So you guys I want to make sure everybody's familiar with swing points. You guys understand swing points, right? And it's a bit ugly, but I want to make sure you guys are familiar with it. So these are essentially a series of highs and lows in an uptrend. And then whatever would be here, this would be the next high here. Um, so with these highs and lows, Whenever you have this low put in and you have a new high introduced that breaks above this high here, that validates this low as the protected low in terms of the trend. So now you're looking for price to come back within the range of this high and this low. And a lot of the times when price comes back within the area, there are different areas that price often goes to. Some people talk about the discount area, some people talk about the premium area. You know, there's quite a few areas that price taps into. You know, whenever it is that we're trending up or trending down, the same thing goes for downtrend as well. So what happens here is that price taps into an area that's below here, that's below this low, below this high. Price taps into an area around here that's responsible for the break of this. And by responsible, I mean, let me see if I could find an area now. Maybe an area we tapped into. I think I just actually caught one. Right here. So if you guys look, this is the high right here. This is the last low that's right here. Obviously, we're shifting structure to the top side, you know, here, like, you know, usually when we want to see our bullish flip. So this would be the long here that we're generally taking. But oftentimes you have it to where if price crosses above a high, you know, a high is taken out. There's usually an area below this last high that was taken out that was responsible for the structural shift above. So usually it's an S&D zone, or there's some sort of imbalance that price may end up tapping into. And a lot of the times there is an S&D zone below here. But if there's multiple S&D zones, oftentimes you can rule out the lowest, because there are times where this has mitigation already within itself as prices pushing up above. Now there, if you look here, there's not a lot of mitigation here already, you know, so price just happened to trade higher, but there was an imbalance. Let me actually make this visible for you guys. There was an imbalance directly above the area, this area here. This was the last down move that sent price up to break structure to the top side. The last down move that sent price up. So oftentimes the last down move is where price is coming back to mitigate before it trades higher. So what I did was I saw this imbalance directly above the zone. And I usually say utilize the imbalances that are nearest to the S&D zone. So I had this imbalance here. This is when the market opened over here. Price tapped the imbalance right here, right above the S&D zone responsible for the structural break to the top side. Price taps this instead of tapping into the zone, and it takes us up. So the first tap usually is a scalp. The second tap is you're looking for a double bottom on the right side, and then price goes up. So you see, we're still actually pushing from this area of market open right here at this imbalance, this imbalance that's here. But if you look, there are swing points that, price is making as it continues higher. There are some swing points that price doesn't return back to right here. Price doesn't go back to it. Just because it hasn't gotten here or hasn't come to mitigate here does not mean that you can't get involved on anything higher than this. Most people are waiting for it to come back here. And if it never does, they're just watching price and not getting in. So now what they're trying to do is they're trying to catch the sell up here to come down here, or try to catch the sell up here to come down here, or try to catch the sell up here to come down here. And they're exhaustingly looking for nothing but sells, trying to come back down to this area because they believe that price is going to come back to this area to mitigate it. And they continue to do that over and over and over again. And it looks exactly like this. Short here, short there, short there, short there, short there, short there, short there. Just trying to create a short to fit the narrative of price coming back to the area. And it doesn't make it there. But the thing about swing points up here, let me actually move this and then erase this. Yikes. So the thing about swing points is that you could have price come down here and you could have price stop here. You could have price make its way back up there and you could have price come here. And it could look like this. And for you, you see an order block here, an order block here, an order block here. And as price is trending, you're trying to figure out price could be making its way down now. Let's say we get, move here, we get just come up above, come here, tap into there, and we go short. Now we short below this low. We tap here. Most people see this tap here. Most people see this tap here. And they automatically think that we're putting in another high here. But oftentimes we end up getting a tap here to retrace up into some area left behind here. And then we continue down. Then we tap here and they think we're bullish and we're going to heaven. And we end up tapping into some area just above. And then we come back down to here. Then they're playing this as bullish, trying to find this bullish move that's going to take us up here. And let's say it comes all the way here. And then it continues down like that. And they have trades that are here, trades that are here, trades that are here. Some losses maybe up here, like here. Another trade down here. All trying to catch price going up. trying to catch the bottom of price because of these areas to the left that they're confusing themselves about. So I mentioned that the areas to the right are the areas that you want to pay attention to in terms of getting involved in continuations. The areas on the left are areas that you're looking for price to possibly reverse and then continue up out of the area. So the area to the left is looking for reversals. But oftentimes we're confusing ourselves with these demand zones that are here, and we're trying to trade each and every one of them. There could be like a smaller one in here. There could be like a very tiny one here. And we're playing all of this trying to just get a move going up. And we're losing on some of them. So now we get into a buy here, it takes us out. We jump into a sell here and it goes up, takes us out. We jump into a buy right here. It goes down, take us out. We jump into a sell here. It goes up, takes us out. We jump into a buy here. It goes down, takes us out. And that's how the cycle of madness continues to look. It continues to look that way. And it's because we're confusing ourselves. Let me actually take some of this. We're confusing ourselves with these zones as price is coming down. Instead of looking for an area that's here, or an area that's here, you know, or an area that's here for price to make its way back up to, like this. We're looking over here and trying to chase the history within the past because we're trying to find reversals rather than looking at areas that are being tapped into on the right side for continuations down. So if you see something is trending down, find an area to get in as it's going down. You'll see the reversal at whatever important area that price may come and touch. Whether it's below or whether it's above, you'll see the reversal within a specific area that it's being rejected from, like a supply area from the higher time frame or a demand area from the higher time frame. So we're trying to catch all of this down below, and these moves are giving us more. These moves here, they're giving us more. These moves here, they're giving us way more. But in turn, we're trying to catch this, and 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 trying to catch, hoping one of them is the point of reversal and we can take it all the way back up there. And that's how we end up losing more trades than winning. So what I always mention while we are trading is that whatever direction we're looking to head to based on the higher time frame bias, take one trade going in that direction. This would already be shifted to break even after one structural low is taken out. And you would just be taking this one trade here going down. And what you can play either side of the market at this point, because now when you get in here, you know it's just a quick scalp. When you get in here, you know it's just a quick scalp. When you get in here, you know it's just a quick scalp. And before you know it, you can get all the way down here. And these little scalps gave you way more pips, way more money, because these little scalps here can be high lot size scalps. You're already in profit coming down. So at any point that you are in extra profit, you could leverage that extra profit also with just a higher lot size to scalp up real quick. So this might be coming down on like a one lot where it's $10, sorry, or $1 per pip. Let's say it's coming down $1 per pip, and you're already here. Let's say, I don't know, you're $200 in the positive here. Now, when you're catching these little scalps up, you might be able to do $10 per pip here. Take a quick 10, 20 pips, 200 bucks there. And you're still $200 coming down, but you just made 200 bucks on a quick scalp. Another 200 bucks on a quick scalp. Another 200 bucks on a quick scalp. Another 200 bucks on a quick Skype. While this right here is just making its way downtown and still reaffirming that we have been coming down from this area and we are still in profit. And this profit that we are in, we are hedging against it to get little scalps within these areas. We're hedging against the profit that we're in coming down. And it can make it all the more profitable while you're trading. Or what you can do is just find areas that price comes back up to continue to compound going down. That's another way that you could manage your risk. But it would just be appropriate to the numbers that are in your account. And obviously you would not get greedy. You know, you're not going to be $200 in profit and now, you know, you're doing $100 per pip. You know, you out in 2 pips, you know, or your profit is blown in 2 pips. It starts to go the other way. So this is one way to have this just coming from this area and this is usually a higher time frame area. Let me say that. You find this trade, this one trade that's usually trending in a particular area. It's usually from a higher time frame rejection, and it's heading down or back down to some sort of imbalance or S&D that's below. So that one trade is when you usually see the larger structural bearish or bullish flip. Sorry, bearish or bullish flip. You see the larger structural one, and then you take price down, and you're anticipating with each pullback, either you could play a quick scalp going up, or you can play adding another entry in going down after it taps into whatever imbalance that may be here, whatever S&D that may be here, taps into there, then you just add in another order to continue. And the profit from this order here is now allowing you to put in a second order directly below it. Even if this does come into a little drawdown, you're still in profit from this order here. So it's only cutting back into some of the profit from the previous area, but you're in no drawdown. You're still in profit with both trades. But this can only come from understanding market structure. Understanding market structure. And I have those videos in the this section here. Where is the foundation section? This video right here, you could even see some of what I just explained. It looks exactly like, you know, what they're saying here. This video here will really, and I'm talking about, watch this video until you could remember, until you can remember everything that they say, until you can remember everything word for word that they say. That's how much you should watch that video, and it will blow your mind with, just the potential of creating systems around this. So the reason why I have it coming down to these S&D zones and you're seeing certain scalps up is because even though these S&D zones are not S&D zones that are responsible for structural breaks, these S&D zones oftentimes, let me move this down a little bit. These S&D zones oftentimes, these S&D zones oftentimes serve, I'm talking about you see the down move before price shifts up. The zone that's left behind, the high and the low that's left behind when price moves out of the area. The high and the low that's left behind when price shifts above this area. Price can come back into it sometimes and then leave. But there are times where price like this doesn't go back to it and continues to trend up. This is an unmitigated area. Now, if this area here is not responsible for, let's see, right here. So we have this high right here. We have this high. Let me move this down a little bit. We have this high created. We still have some area that price fell from down there. So we're looking for the area responsible for flipping us above the structural high right here. We're looking for that area responsible somewhere down here for shifting us above this, because that particular area is where we are going to tap into and then take another leg up. That's the bullish area that price is looking to make its way back to. So bear with me, it's all going to come together in a few. It's going to come together when we get to the charts. I'm going to show you guys this. No, it feels like a college lecture, but just bear with me. So this area here is not responsible for anything. This area down here is responsible. But when price comes to this area here, price still gives you a reaction to go up. But that reaction that you're getting from here to go up is just a retracement to go to a particular area and tap into that area above to come back down below the area that price tapped into. So you have people trying to buy. They continue to do that over and over and over again, rather than understanding that it's buy to sell to buy, to sell, to buy. That's how the market moves. The market moves like that. And you can time each and every one of those taps. You can time them. They may not be entirely perfect, but you can time them and create a system around it. So as we have this trend going down, we have, now mind you, this is the higher time frame area that we tapped into. So if we reject it from a higher time frame, we know that it's a heavy rejection from somewhere up here, and we're coming back to something down here because it's rejecting from supply on the higher time frame to demand somewhere down here. So on the higher time frame, we understand that that's where price is targeting, but on the lower time frame, we see price trending this way. And we're looking for areas to get involved in price. And there are areas that you can get involved where you don't have to utilize the current trend, or you can utilize the current trend. It just depends on how you see the market. You utilize the current trend, you're going to get more value for your trade. You're catching an area or tapping into an area to break structure to the downside. So you get a discounted move and then some. You at least get 2 times what you were expecting. Either the break of the structural low is one, and then it could cross other structures below if there are no bullish areas that price is tapping into. But remember, since this is a bias from the higher time frame, all of these moves up, we know they're just temporary retracements until we might see on the higher time frame that, oh, maybe there was an imbalance within here on the higher time frame, and then it sent price up to here. Maybe we miscalculated on that, you know, or it would just continue to the overall targets. Sometimes it's just based on what people have charted out. There are people who have certain demand zones charted out, certain supply zones charted out, and they miss the tiniest imbalance that's there, and price actually taps that and goes away because they didn't have it charted out. When you have these things charted out, it's giving you an explanation for everything that price reacted off of and why price retraced, where price retraced to, and where price continued down to. When you see that over and 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 over again like that, you begin to become confident in playing different sides of the market only relative to that rule that you have on whatever side of the market it is that you're looking to get involved in. So I'm going to take you guys to the charts now and show you guys exactly how this plays out on the charts. Let's see, let's find a trend. I want to find a clean trend so it's just easier to give an explanation to. And yeah, let me, because there's different ways to play this. It's just that I'm introducing this to you guys, and you have to be able to play the foundation of it first. and then you can kind of add your own thing into it. So let's see. Trying to see. Let me see if I could find a pair that'd be swanging. Yeah, let me see if I can find a pair that's it's giving us some nice swings. I think oil had some nice swings today. Nope, it did not. You guys probably see me scrolling around looking for a particular area and thinking, oh, well, maybe this doesn't happen everywhere. It does happen everywhere. I'm just trying to find a cleaner area to show you guys how it plays out so you're not struggling with the basic understanding of it. Let me maybe go to the 15-minute because those moves tend to be clean. Okay, right here. Oh, look, we have do we? Okay. So we talked about swing points. Within certain trends, there are swing points within swing points within swing points. So, you have this here, you go up, break structure to the downside. This last move here, the swing up to where price broke structure to the downside, this is the last swing point that price had. Then price goes break structure to the upside. Price comes down to this area here, and then price pushes up to here. Price comes down to this area here, and then price pushes up to here. Price comes to this area here, up to here. So you guys get the understanding. You see how none of the swing points really do not look the same. They really don't look the same in terms of there was some sideways movement within this whole swing point here. Price shifted up. Then there's, movement down into this area, tapped in, and then price shifted up. So what we also don't see or maybe don't even consider as we're looking at those swing points is that within this area here, there are also swing points happening. Also swing points. Just smaller. So we have this here. We have this here on the inside, these swing points on the inside, along with these swing points on the outside. These are institutional swing points. When these swing points are violated, that's when the uptrend is getting ready to shift and assume a downtrend. So you would have a violation of this structural institutional low. You'll have price retrace into the area, and then you'll have a short out of it. And that would be the beginning of a new trend, the beginning of a downtrend. And you can spot that on your own by just keeping track of these pivot points. But there's the inside structure pivot points, and then there's also the outside structure pivot points. And a lot of this is explained here in this video. You know, so I'm just giving you guys a piece of that. But what I'm going to show you guys is with utilizing what I'm showing you, you need to know structure. You need to know how to utilize swing points. That's imperative that you know that. So with institutional swing points, along with smaller time frame or smaller structure swing points, oftentimes price will go above a particular swing, come back to it, and trade higher. And because you have small swings, large swings, you want to know within those swings, within this swing here, you have price break above here. There are multiple areas that you see price can reverse and come in touch. Here, you might have this area marked out. You might have this area marked out. And there's so many what ifs about price tapping into these areas. So what we mentioned was that this is, yes, a smaller swing point, but also a demand zone that's responsible for breaking structure to the top side, breaking this structure here. So you're looking to trade from here, not here, not here. You're looking to trade from the area responsible for breaking structure. Now, what I will say about utilizing that area responsible for breaking structure is that oftentimes when prices has shifted bearish already from somewhere up here, that doesn't hold. And price continues going down. We might have already tapped into an S&D above, but we're looking to come back to this here to go bullish without paying attention to what just happened at the higher time frame up here. So we get confused as to why it didn't work out and why price came further down here maybe, and then maybe came up here, and then down here, and maybe came up here, and then down here. And we're trying to figure out why this didn't hold, or sorry, why this didn't hold. And it's because you may have missed something from the supply area, from the top area. We might be getting rejected from an imbalance, from a zone, you know, that's above there. There's plenty of explanations as to why price would shift through there, but you would also know that since that was the last area that price could hit and put in a new high, if it goes below that area, then consider the rest of the area lunch meat. And that gives you a bias that price is often going to shift through these areas. So with these areas here, you see how price never came down and touched these areas? With these areas here, if price ends up coming down to maybe mitigate this area below, sorry, this area below here, if price comes down to mitigate this area below, right here, I don't know, let me just, okay, yeah, right here. Let's say price comes down to mitigate this area below. You're going to see that you'll get a reaction from each one of these, even if they're unmitigated. Even if they're unmitigated, you'll get a reaction out of each and every one of these, or not each and every one, most of them. You'll get a reaction up out of most of them like that. Like that. Even though this was responsible for the structural shift, we already tapped into it and went. So if you have price coming back below this area, then we're shorting through the area, but we also have long opportunities that are present from here, quick scalp up, here, quick scalp up, here, quick scalp up, here, quick scalp up, while you're in one trade coming down here. So now you have one trade dropping, and then you have quick scalp up to trade down, quick scalp up to trade down, quick scalp up to trade down. So now you're understanding how the trend is forming. So with this, let me actually go back to the US 30 now for the overall explanation. This right here is a swing point. This high and this low. Swing point, price trades above, price doesn't come back into it. This leaves an unmitigated area. When price comes back to the area, usually trading down, we're looking to tap into the 50% of that area and potentially get a move to take us up. So let me actually see. I didn't even pay attention. So you see right here, we tapped into the area. You see the middle right here where this crosshair is? We tapped into this area and we pushed higher. So now that you guys get an idea of swing points can be utilized as some form of directional bias and reversal. And I say that because take for instance, this swing point here. Price trades out of it, comes back into this area, back into the swing point. Price taps the 50% of the swing point here and keeps going. But not just that, if you happen to miss the larger swing point, there are smaller swing points that are in here that build the trend. So now you have this area here, this tiny swing point. Remember, we just missed this larger move, but now we are looking for continuations. So what do we have? This tiny swing point here. Price comes, taps into it, and it leaves. We see this swing point here. Do we get anything from this? No. There's another swing point directly above here, but price ends up trading through it, but still continuing above. So what do we have? Now this swing point here, this high and this low. Now we place a square over the swing point. When price trades above the swing point, above this swing point, this move went up to here, traded down below to here. When price trades above this area, above this high, you're looking for price to come back into the 50% of this previous swing point that we just traded above, we just traded out of. You're taking the area of the previous swing point. You place a square around it. Price comes back into the area of the swing point. We tap right into the middle of it and we trade higher. you have another swing point that price creates here. We didn't get price coming back into it. We had this where price came down and went back up. But what do we do now? We take this swing point here, because this is also a swing point. This one down candle into this up move, this is a swing point too, just on a lower time frame. So what do we have? Price taps into the center of this swing point, takes you up. But then price also taps into the center of this swing point and takes you up. Actually, it goes a little further into the swing point down below to here and ends up taking you all the way up here. But the same way that you can trade swing points as the trend is going up, you can trade swing points as the trend is going down. So here you have it. This is the last swing point. I don't even know if it actually tapped, but this is the last swing point. This up move and price shifted down out of it. When price shifted down below it, it came back into the area. 50% of the swing point, you see, clean tap. 50% of it, the larger swing point, this here, the larger swing point, this previous swing point, it comes back into 50% of it, and then it shifts down. It leaves. So oftentimes you have it to where there's large swing points, there's smaller swing points, and price even responds to the smaller swing point. Because now look at this. This is a larger swing point here, exactly at this area. If you were to take the 50% of this larger swing point and find the swing point within it, or maybe the imbalance that could be up here or something, you would end up pinpointing the exact area that price is coming to tap into, and you may be able to short using that area with the overall bias that we were coming back up to the 50% of this swing point. So now your bias is that we're coming back to the 50% of the swing point, but we found a smaller area in there within the 50% or above that we can refine price to, refine our entry to. So we took the swing point that was within the larger swing point, and we got to tap into it, and price traded below. So what you guys need to understand with these swing points is that the larger swing points are more likely. The smaller swing points are easier to break through. And what most people don't get is that these swing points up here, these swing points that you guys see me marking, they're just supply zones. They're order blocks from the higher time frame. Right here, let me see, maybe the 2 hour. This is 1 2 hour candle, or even a fractal. So you see, this is a fractal from the 2 hour time frame. But when you go lower, it opens up to other things. So this is why I'm saying utilize fractals as zones as well, because fractals are supply areas. Swing points are supply areas left behind. So you have this swing point here. Price trades up into it. Yeah, there's a little bit of drawdown, sometimes depending on where you brought it, where you drew it. So this, from this low, I'm telling you to learn how to draw from the low to the high, and then when price trades below it, you're looking for price to come back into the 50% of that swing. That's what I'm telling you guys, because you need to first be able to understand how this works. But my actual swing point, when you start understanding swing points, my actual swing point would have just been the low of this candle here to the high of this candle here. And I would have got a cleaner tap, less drawdown, but price taps into the area and it trades below. So with these swing points, you could utilize these swing points as directional bias from the higher time frames. You could utilize them as directional bias. So now that we have this swing point here created, now when price begins to short, if we're going to continue higher, we need to find the reversal in the middle of this previous swing point here. Sorry. Here. So now, when we're shorting, we have a direction on where price is going to, but we also have an area from this 50% of where we can potentially narrow down price doing something in here. So now that we have the 50%, we know that we're looking for price to come and tap into anything below this, the 50%. So now when we open up the 50% and we look, what do we see? We see the S&D here responsible for breaking structure here. So now, likely area, 50% of our swing. This within here is the S&D responsible for breaking the structure up here. We also have an imbalance here as well, multiple imbalances below, which makes this area likely for price to come down and mitigate as well. Imbalance just below it, mitigated also. So we're not necessarily looking for price to come below this area, but we found this area from our swing point, the 50%, and refined within the 50% of that swing point, the area that's responsible for breaking structure. So now this becomes the area we're looking for. But one would ask, we have a bunch of imbalances. How do we know price won't tap into any of these areas? It's a great question. Price can tap into these areas, but guess what these areas would overall end up being? It would end up being a reaction at this imbalance, 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 until we get to the targeted area and then we reverse from here. So now as price is shifting back down to our swing point, because the larger swing points are the likely swing points that price will come tap into and reverse. Now, as price is shifting back down to this, you'll see that you will have multiple opportunities to scalp this imbalance up, scalp this imbalance up, scalp this imbalance up, scalp this imbalance up, maybe scalp this fractal up, scalp this S&D up, because we know overall we're in our one trade coming back down to here. But we know all of the likely reactionary areas that are here for price to give us a nice quick pump up. We're scalping off of that. As we're coming to our likely area for the reversal. So this would get rid of that mindset that you guys are expecting us to reverse from here, and maybe 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 reverse from here. We're not expecting reversals no longer through here. We're expecting scalps up. But not only do we get our scalps up as we're coming down, we get the rejection from here to here. from here to here, from here to here, from here to here, from here to here. So any side of the market that you want to play on, whether it's a scalp up or a continuation down, you see it all happening. And the areas that it happens in is the zones that you're looking to trade from, but those are only reactionary zones. The actual zone that you're looking to reverse from is just one area. And any other area that's along here, you're only looking for a quick scalp. But what I will say is that with the imbalances, price can often come directly to this imbalance right here above. Never tap into this S&D zone down here. Never tap, sorry. Price can never tap into this here, but it can tap right into this imbalance just above it and then continue to put in another high. And smart money and all these people are waiting for this, oh, juicy order block to come. Yeah, oh, hit that area. Imbalance gets tapped and it goes. That's where the imbalances become game changers for you. And this is why I mentioned that areas that are likely, because price broke structure from that area, choose the imbalance that's there, because it could reverse at the imbalance and not the S&D. And sometimes it will reverse at the S&D, but there are times where it will not go back to that S&D. It would just hit the imbalance directly up. Look, it did it right here. Sorry. Look at this right here. This area here was responsible for breaking structure here. Price came and tapped this imbalance and continued up. And all these other people who love to play order blocks and all that other stuff never got a tap. Never got to tap into it. Oh, we're waiting for price to tap into this demand area. Never tapped there. What did it hit? The imbalance directly above. So we want to look to get involved on most of these moves, as they can turn into just a quick scalp for you, and oftentimes never come back down here and end up being a longer move that you're taking up. So you want to get used to understanding the reactions that are in these areas and how to capitalize on them. And because they are reactions that are because these reactions are you know, like you're kind of playing them in terms of when they tap in and they go, you can capitalize on each and every one of those, being precise with your risk management. So if you tap into the 50% of this area, because it's a likely area, you may be able to risk a little more on it, risk 10%, 15% on it, because you see that these reactions off of these areas tend to be very, very short and very, very powerful. But with the imbalances, what I will say is that with the imbalances on the higher time frames, price tends to go a little more than the 50% with a lot of these imbalances. So sometimes price will go 61, 68, you know, like within that area, 70% even, and then continue up. So you have to be able to brace yourself for some of the drawdown that you could be in, if there's any. You have to brace yourself for some of that drawdown, and that's where risk management is important, because charting is not the only thing that's important to profitability. Risk management is actually the thing that creates profitability, because you create some sort of system within your scalping that you're able to take certain calculated risk, and you're able to make, you know, small portions of money. Let me see. I end up holding a lot of my scalps too long and it retraces on me. Yeah, that's true. How do you decide to hold for larger moves versus it's just a scalp? Like, what changes your bias from a scalp to a longer move? What changes my bias from a scalp to a longer move is a structural break. Because let's say this turned into a scalp here. Like, this was my scalp here, my quick scalp up. You know, price trades up here. price comes back into this area, you know, I'm in from down here, so I don't really care what's going on here. But as price continues to go and you start to see structure breaking, you start to see structure breaking to the top side, you're not getting out of this because you know at the end of the day, price is only coming back to this swing point. And price will tap into the swing point and then take you higher, which this is exactly what it did. You guys see this? This candle, this green candle with this wick sent us above the swing point. This green candle. When we closed, we came back into the 50% of the swing point, tapped in, and we left. So if this is a bullish trend that's trending, it's only coming back to particular areas, tap into it and go. Because we already broke structure up here. Once we broke structure up here and you got in here, your stops are at break even here. But you are expecting some retracement back into the area after the structural break. So a lot of the times you might be getting in, you might be scalping from here and price goes up. And then when it goes up above this structural high, it comes back into the area and takes you out at break even. And then it ends up going above to wherever it is that you thought it was going to. And a lot of the times that's because not understanding where you are structurally. And this is why I continue to talk about the understanding structure is very, very important. Candlestick structure, intermediary structure, institutional structure, and utilizing all of it. What would be the confirmation to get into a tap of the imbalance and not wait for liquidity to get to the OB? The requirement to get in on the tap of this imbalance is that if price taps in, let me show you. If price taps into this imbalance and shifts above the area, you want to see price come back into this area that's above the imbalance tap here. You want to see it come back into the 50% of the area. This is a swing here, this one candle. This one candle is a swing on candlestick structure. So this candle actually created the imbalance actually created the swing because price shifted down, tapped the imbalance, and then swung it up. So this imbalance created a swing, and all we did was take that swing. And when price trades above it, we're expecting price to come back into it, which that's exactly what it did here. If you guys look, tapped right back into the center of this one candle because this one candle is the swing. Came out of the swing, tapped back into it here, and then traded higher. So this is why understanding the different types of structure can help you to get into trades before, you know, smart money is waiting down here for their little order block taps. ICT bros are waiting here to get into an entry and they can't. And they go, oh, ICT doesn't work, you know, or this doesn't work and that doesn't work. And a lot of the times they just don't really understand, you know, like how price moves, how the algorithm moves. And they end up getting caught out there like this, you know. So you can utilize swing points, but not just that. Not just that, guys. Swing points work on higher time frames. So this is the 1 hour time frame. If I take this swing low to this swing high, when price traded below it, we had price try to come back up and trade it down, but we had this area still unmitigated from the 1 hour. So if we wanted to catch a higher time frame reversal, we would have chosen a higher time frame swing point. And not just that, remember, with the higher time frame swing points, what we're looking to do is get in at the 50% and our stops are behind here. But this is a lot of risk. So what I do is I take the 50% of the swing point and I look for a possible area within this 50% that price could potentially tap into and give me some reaction. So guess what that becomes? Imbalance, 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 imbalance. There's always imbalances within these swing points. And since imbalances give you the stronger taps out of the area, you find the imbalance that's likely to react from the swing point. I hope I'm not losing anybody here. So now you take this imbalance, and now the imbalance becomes your entry, and the 50% becomes where you're entering, and your risk is directly behind the zone. Why not choose the imbalance above that one? The imbalance above this one, this is a swing point. I'm looking for price to tap into the 50% of the swing point or above. But if you look within here, there's no volume up here. Remember how we say price is attracted to volume? There's no volume up here. This is price going straight up to immediately pushing straight down. And it left an imbalance. There's no volume in this top area. Where were we consolidating? Up here. There's no consolidation here. So consolidation is important because when that area comes back to be tested, then you usually get a reaction out of the area. So we consolidate up here within this swing point right here. We consolidate within here, and then we get a tap into the area and we short from the consolidated area, from the area that has volume. So we're choosing this imbalance here, knowing that up here, there's no volume there. And most people are using these volume indicators and they're like, oh, if price goes, I don't know, let me see if I can find that volume indicator that people are using right now. It's like a huge trend that people are using. It's like I don't even know how they would capture this. Maybe it's the last swing or something like that. Let me see. Maybe it's here. Who knows? Yeah, I don't know. I don't see the volume indicator is showing that the volume is here. So people are utilizing this volume indicator with these swings to find out where the volume is and where price potentially may react from, when you can already see the volume with your own eye. You can see the volume with your own eyes because the imbalance chosen is in the 50% area. Yeah, exactly. That's why the imbalance that I chose is at the 50%. We're usually looking for price to react at the 50%. Sometimes price can go a little further up within it, but we're looking more so for price to react at the 50%. So we take the area at that 50% and utilize that as the most likely area for price to reverse from. And that's just on the swing point. So usually you want to make sure that within that area, there's also some volume there, because we know that price is attracted to volume. And now you no longer have to use this little volume indicator to tell you where volume is. Or, you know, there are people who are like creating strategies off of it where, you know, they're like, if price goes above it and once it comes back below it, you get into a short. I have no idea what any of that stuff is and how beneficial any of those things are. Like this I would never endorse that at all, because what's the structure behind that, you know? Like what, like they would have it go up above here, and they would place a sell stop right below here, and they would wait for price to tap them in and take them down below here. And you know, they would take that momentum entry below this volume part, whatever this is called, because I don't use this indicator, so I don't know. Like where the most volume is, they'll take the entry here when it comes below that area. So I've been seeing people utilize this to trade with, but I still think that you can find the volume just using your eyes. You don't necessarily need to use an indicator to help you spot that, because you can already see the volume just in the clustered areas, the areas that are consolidated. That's the volume areas. Crystal clear. That's great. This is what many traders would call buy to sell candle, or sell to buy candle, or institutional candle. 50% of that last candle that caused the break. I back tested this on TradingView. At the second tap of the 50%, you barely get caught in drawdown. Exactly, yeah. You barely get caught in drawdown. Barely. You know, because of tapping into that area. But then you also have to know that sometimes those areas are not touched. Like the smaller swing points. We try to choose the smallest swing points for price to react off of. Let's say we chose this swing point down here, right here. Right here. We had price go above it, so if you put your stop directly above the swing point, you would have just been taken out, and then we had a reaction down. You know, but this swing point wasn't a swing point that gave you a clean rejection and took you down. So if you utilize the wrong swing points as well, oftentimes you could end up becoming, you know, mixed meat. And you want to utilize the swing points that are in areas that have volume to it. Areas that have volume to it. You want to use those swing points. So with this swing point, we wouldn't necessarily be using this here, but we would also look to maybe spot something above, like an imbalance or a fractal or something above here. So I think this is a fractal tap here, which also there's this S&D here, this hidden S&D back here, right here. Yeah, it's hidden S&D here. So price usually taps into it, rejects out of it. Let me just move this. Price usually taps into it, rejects out of it, and then liquidates it. So it looks like, let me see. Oh, it didn't even liquidate it. It came really close and then shifted down. Yeah, it didn't even liquidate it. Actually, I'm wondering. Oh, no. This, wait, is this? No, I'm tripping. It's not. I'm thinking this was the news the other day on June 28th. Because we had that huge push up followed by that push down. Oh no, this is news, right? Yeah, this was news or something like that. We were talking about this area, and then price shifted down for the rest of the day. Yeah, that was news. That was news. Oh no, it was this. I'm sorry, I'm lying. Look at me over here, telling the truth. About to go to hell. I'm kidding. So yeah, the swing points. Let me see. After I stop using indicator, I feel more secure off my trades. Yeah, and if you utilize these swing points as areas to scalp, you could certainly just, you know, impact your trading. In terms of like scalping those 10, 20 pips. Make 10 pips your hard partial, or 20 pips your hard partial. So it creates this discipline that you're out in 10, out in 10, out in 10, out in 10, out in 10. So for every trade that you take, now with the US 30, it's going to be more than 10 pips with those reactions because we see how heavy those are. But it'll just be out in 10, out in 10, out in 10, or partial at 20, partial at 20, partial at 20, partial at 20. And when you get used to it, then you'll see that, okay, now I could up my risk a little more. Now I could hold a little more. And as I'm holding a little more, I'm able to be confident in my trade and maybe add in a second position, or maybe take a scalp from this area back down. But I know we're not going all the way down. We're just retracing to here. And I could stay in this trade right here and head back up. You can only spot those things and understand those things when you are using structure. So I'm teaching you guys about these swing points, but I also want you guys to understand that with these swing points, you need to know structure. So this area, we tapped into this area. I think this area was like called out on stream or something like that, or right before stream. We tapped into this area. And I have mentioned that we were coming down here. What did I see down here when we came down? This tiny swing point from across the way. And if you look within this larger swing point here, price traded above it, came back and mitigated it, and then traded higher. But we have an area below, a demand area that was created below that went untested, went unmitigated. So we had news happen that took us all the way down here to tap into our area, our swing, the last swing before price shifted to the top side. Why is this swing important also? Yes, we got to tap at the middle of this swing and we got pushed up. But this swing is way more important. Why? Because this is the S&D that broke structure to the top side. So regardless of the swing, we still have to come back to mitigate the S&D responsible for breaking structure to the top side. And oftentimes those little tiny mitigated areas that are left behind are usually areas that the news trades to and bounces off of heavy. And most people just are not aware of the little areas that are here that are left behind and not knowing how they potentially are used. So most people might have been jumping into a sell to come below here, but this is a swing that was responsible for breaking structure. The swing was responsible for breaking structure. The swing was responsible for breaking structure. So we came back to the swing that was responsible for breaking structure. Last area that needed to be mitigated before we assume trading higher. And that's why we tapped into this area here and went bullish. So guess what? What areas are we potentially looking into to go long from? And in the event that there's chaotic news or anything like that that happens, but the market is not shifting bearish, guess where our next high impact news event will take us? S&D left behind that was responsible for the structural break above. And after Biden crashes the stock market, like everybody says these days, then you start to see some normalcy heading back up. It's like, yeah, we're rallying again. Oh my God, we're doing great. And they just don't understand how structure works. So that's me teaching with swing points. It goes even more in depth with these swing points, by the way, guys. Because there are ways to know which swing points will get liquidated entirely. So oftentimes price has one swing point here and it leaves another swing point above here. And if it fails to make a third swing point up here, a lot of the times you'll have price come tap back into this area, give you your pump up, but we failed to make the other high. And when we fail to make the other high, we're just liquidating the second swing point that formed to take us back to the first swing point. And then the first swing point is where we end up actually going long to put in more highs. But since a lot of people don't understand how all of this kind of works together, they're usually tripped up in these swings, you know, trying to find the bullish area, trying to find the bearish area, trying to find the trend in this and that. And if you just understand how these areas are utilized, most people think that you take the high here, the low here to, you know, the high here maybe, and you're looking to maybe come back into, sorry, not the main, this is, actually, let me just move all of this. So they go here, and they'll take this here. Sorry, default. And they're looking for price to come back to this area here. And there's this swing here. And within this swing, there's this swing here. But being that we understood that this fractal right here mitigated this, what you may end up getting is price coming to tap this fractal, because now this fractal becomes the demand zone. The area that's responsible for mitigating the demand zone becomes the new demand zone. So this becomes the new unmitigated demand zone. And within this swing here, we have two areas. We have this area here that's responsible for the structural break here. And then we also have this area here that's responsible for even this, you know, this structural break, this multiple structural breaks. So if price ends up coming back down, it can tap into this area, not even go back to this, or even tap into the middle of this, and then assume to put in a new high. Because this is the last unmitigated area, specifically this fractal being the last unmitigated area for price to continue to trade higher. Because we broke this structure, we came down and mitigated it. We broke this structure, we did not mitigate it. So this is still outstanding right here, but we can potentially have a tap back into this area. But then we could also take the low of that area, tap deeper into the area, and then actually take the high out of there. But this is just essentially showing you guys areas on how to spot reversals, in real time, utilizing swing points. So now these you leave out wicks when defining swing zones. Only wicks that go below a particular low. So if you look at this, this wick right now, is it? Wait, let me turn this. No, it's not. So it's only wicks like this right here. You see this swing point here? This swing point from this wick here to this wick here. So what I've found, and you guys might find different results for you, or different things that you might see quicker and may understand a little better. But what I've found is, remember how I said there's the liquidity grab candle where price, you know, goes below a certain low and then shift above it and it continues up. So this candle I say we discount the wicks because it traded below the previous low here, both here and here. It traded below it, but then it closed back inside of the range of that candle. So because we traded below it and closed back within the range of that candle, this wick is considered manipulation. So I'm not using the wick because that's a manipulated move. It was a manipulated move down before price went up. They're not looking to come back to this move. This move shook people out of the market and it pushed back up. They're not looking to come back to the move that shook people out of the market because that would bring them back to break even. And what profitability is that? So the reason why I discount that is because oftentimes when we come back into the area after trading above, we actually tap into the only the 50% without the wick and price trades above. So we're not counting this because this is a liquidity grab. If we counted this with structure, then we missed the move. And we would continue to miss moves. And then when price comes back to this area, we try to catch the move here and it just rails through the area. Because we missed the actual move when the actual move was here. And it was this fractal that mitigated this area, this swing. A fractal is a swing. This fractal right here was the swing that mitigated the area and left. So now that makes this fractal a likely fractal to have a reaction on. You guys understand, what I'm saying? I hope I'm not losing anybody. I know it's a lot of talking I've been doing and a lot of explaining, but this is how you can find likely areas. I got lost on a fractal. So in this frequently asked section here, there's some explanation of fractals. What are fractals? It's a super quick, easy explanation. It's about 1 minute long. And it would kind of catch you up to speed on that. But the fractal is a swing point too. It's a down move. You see it started at this wick. A fractal is a swing point on a lower time frame. A lower time frame. So it's this here, this high. After this high was put in, we shorted and put in this low. And then we left the area. So this becomes the area left behind for price to come and tap into, because this area that was left behind mitigated a previous area. So this becomes the new area for you guys to trade from. And that becomes the new demand area below. So if we're looking to give us another like kick up, another leg up, or a sizable reaction up, we'll get one here because this is still responsible for the structural break here. So there can be multiple ones that's responsible for different structural breaks, because this is a structure here. This is an intermediary structure. This is a institutional structure. This is another type of institutional structure from a higher time frame. This is another type of institutional structure from a higher time frame. So that's why with every swing that we have down and back up, price comes back to tap into it and goes back up. Because we're breaking multiple structures, but we're also returning to those areas that are responsible for those different types of structures being broken. And that's why we have candlestick structure out to intermediary structure, out to, overall or major structure, out to institutional structure. It all just, vibrates out. What time frame do you prefer swing points? Use the 15. If you're day trading, use a 15 swing point. If you're day trading, just take a 15 swing and use that as an area that you could potentially get a reaction from. But the truth is, on the 1 minute, you could still find pretty good swings on the 1 minute. Where are we? We're here. So this was coming up. So look at right here. This is how I spotted this trade. Oh, I'm going to lose all of my stuff. I just realized I didn't go back to add the stuff on the chart, but it's cool. This is a swing point here. It's a swing point here. Price comes and taps into it. But look within here. And this is how I modify some of my swing points to get a more accurate move. This is candlestick structure now. You have this high, you have this low. You have this high, you have this low. You have this high, you have this low. You have this high. You have this low. You have this high put in. What are we seeing over here? Well, this, would I really count this as a low? I don't know. No, I don't think I would. All right, so let's say it's this. This is so ugly. Let me actually just. There you go, better. So we have this swing that's left behind right here. We said it was what, this high here? No, it was down, up, down, up, down. So it was this. We have this swing here. Price shifted down and broke up above it right here. Let me move this out the way now. Shifted down, broke up above it right here. So I'm using candlestick structure to spot a swing in candlestick structure to take for a move up. So what I'm actually doing is I see this larger swing here, and I could use this larger swing as a guide for, like price coming down to at least a 50%. So that's at least right here. And within this area of the 50%, I'm looking for an area that price could potentially react from. So I could actually use this S&D here, this one candle here. Price comes, taps into the 50% of this S&D here, and trades higher. Now that's when you know candlestick structure. So I'm gonna come back and do another teaching on using the candlestick swing points. But you guys need to be, you guys need to consider that if you take these swing points, they'll give you some sort of directional bias. So with this swing point here, this swing down followed by this move up, I caught this move because I saw this 50% of this swing point. But guess what? Within the 50% of the swing point, if anybody knows the way I trade, they would see that I'm always telling people about imbalances. We have an imbalance smack dab in the middle of the 50% of the swing point. What better imbalance to use than that? We got our scalp off of it right here. Scalp up off of it. We got our double bottom for the second touch, and then we longed to where we went today. And this is utilizing the swing point from market open. So you can't ask questions like, which swing point should I use? Which swing point shouldn't I use? Which swing point is likely? Which you got to back test it and see how the swing points react. Back test the large swing points and the small swing points within the large swing points. So this is the down move right here. This is the down move structurally. Sorry, I don't know why this isn't clicking. This is the down move structurally, and then we shift it up. But the real down move within this area, this schematic, is actually from this high here to this low. This is the real down move that sent price up. So you're using the larger swing for direction, for possible areas to spot your reversals. And then you're using the inside of that area to lower your risk. Now you have a double confirmation already within this area. This is unmitigated. This whole thing is unmitigated here too. And there's some imbalance within here, or whatever it is that could be here that has not been tapped into. When price gets down to this area, you'll often see a reaction out of it. But it doesn't mean that it has to be a reaction that breaks the high. It can just be a reaction back up to tap into some area up here, because we could have hit a supply area up here and we know nothing about that. So this is why understanding where you are in structure is important too. So I hope you guys got something out of that. That's how I started trading. And I have mentioned to you guys, actually, where is it? I have mentioned to you guys, when I first, where is it? Let me see if I could find it. I'm trying to get it. Bear with me, guys. Right here. When I first started trading this and understanding this, these were my trades. And if you look, some of them didn't get tapped into. This didn't get tapped. This didn't get tapped. This didn't get tapped here. But look at all of this. And I told people, you don't need the left side to trade. You only need the right if it's trending. If we got a structural shift, you only need the right side. And look, I'm trading up and down on this right side. Up and down. I'm counter trend trading with the trend. Up, 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 down, up, down, up here, down here, all like back and forth everywhere, because I understood how price moved. And, now you guys kind of get an idea of, I was using swing points. And if you use that on those days where we have those nice rocking pullbacks, use those swing points and you'll see that you could, get quite a bit of trades. You can get involved in quite a bit of trades if you're just utilizing swing points. I usually go just like this on stream and nobody knows what I'm doing, but I go just like this. And I'll place that there. And most people have no idea. And then there's like a little tiny swing point within here. And I go, okay, but this wick came down and came back in, so now we have it there. So we rule this area out, and we have this area if price does come below. But then we see this one candle here is a swing point that's unmitigated. So we use that zone there. And then we have a larger swing point here at this area. And this is where we kind of look at what price may do when it comes back to the area, and it could potentially reject from these areas back down, and you're only utilizing what's on your right side, not on your left. And in times of like high volume, a rejection like this is like 2 pips right now. A rejection like this can be a lot more. It could be like 30, 40 pips from a rejection like this. And who's to say you can't scalp that real quick? Scalp it maybe from here, maybe to the imbalance here, which is like 30 pips in the New York session. And from this imbalance back up to take this high here. And then from this area here, because this is a swing point and we know price comes and taps into the swing points and rejects out, maybe back to some imbalance here. And then from whatever imbalance or from whatever zone to maybe take the highs, because these are mitigated already. So if price trades above this area, these are previously mitigated areas. So we know we would be assuming the high. And that's how you create the narrative around utilizing these swing points as, look at this rejection, guys. Swing point. That's what I'm saying. Like, I try to stress to people, watch what I'm talking about. Like, watch the videos that I'm teaching with, because I'm saying things over and over and over and over and over and over and over, and it's right in front of people. And a lot of the times they miss it because these little things that they're just not noticing. This is right in front of us. This rejection right here would have been a 30, 40 pip rejection in the New York session. I just placed that line there and said we could get rejected there. And then guess what? We could let's say we get rejected here. Let's say we come here, we tap here. Let's say we come back to this imbalance. We come back up here, reject out of here, come back to some area here. Let's say we take the high here. We assume up. Guess what? Come back down to here. Maybe some imbalance here, maybe the imbalance directly above, and continue. And we are noticing the areas that are forming the trend. Forming. So let's say we got a rejection here, came back down to here, back up to here. We are looking to the left to give us the areas that's providing us with the retracement. We are looking to the right to give us the areas that are providing us with the continuations. And that's how we play the zones to the left. But the zones to the left are meaningless if you don't understand structure, and if you don't understand what candlestick structure is. That's why I have candlestick structure in that playlist. It's the first video that's there. It is so very important for you to learn candlestick structure, because it's the fastest way to get into your entry, and it's at the earliest time that price is shifting that you can get into your entry with candlestick structure. So, you know, I want you guys to just consider that. There's more teaching on these swing points because it goes a lot more in depth, insanely in depth. You guys might think that you learned something today. Boy, and girl, if there's any girls in here, you don't know. And anybody else who identifies as anything else, you know, you guys don't know. You know, like it's wild. It goes very, very in depth. And you know, I want you guys to understand how to get involved utilizing these areas. And all it is swing points that they're mitigating. That's it. All they are swing points. You know, so it's best to use the 15-minute swing point or an hourly swing point as well. And more times than not, you get reactions from those. So let's say we use this swing point here. Look at this swing point. I just noticed this, but let's see if it works. This swing point here. Remember, this wick, we're not using this wick. We're using this to this to this. Swing point, this to this. Look at us. Let's move this over. What do we get? From this wick here to this wick here. here. Tap. And we make our way up. When you start to understand how to mix and match the wicks and the swing point and all of that other stuff, it would begin to open up your eyes in terms of like so many areas on the chart that you could trade from that you had no idea. And you can just create little setups from it. Oh, this is a scalp here. But if it comes back up here and taps up here, this is a short to continue. But if it comes down here and taps here, this is a scalp. And maybe it comes to here and taps here because this is the S&D zone responsible for the structural break to the left side. Maybe it comes in and taps here and gives you a double bottom here. But look, we might have already got a tap here. So maybe that's why we started to flip bullish, because we tapped into this S&D here. So now we know that we're flipping bullish from tapping into this S&D, and we look to get involved on the downside now. So now what we're looking for is potential areas for price to come back to and give us touches on, with one being here. You have this one here. Was this mitigated? Nope. You have this one here. This wasn't mitigated either, but price just traded above it. So now you wait for it to come and tap back into here. Now it could come and tap into here and continue up. It might come and tap back into another area there and continue up. Then might tap into another area there and then shoot up out of nowhere. And then come crashing down to break the trend. And now we're going downtrend and we're hitting the middle of the swing points, going down. And this is why understanding structure is important, because you would have an idea of which swing point you're using and why you are using that swing point. That's why the structure videos are very important. So this will help you, but those structure videos will maximize your learning. I promise you, will maximize your learning. You know, so yeah, it's crazy. Let me go through some of this too. Stop loss below the wick would be safe. Yeah, because they're not returning back there. They're not bringing people back to break even. They're trying to get them out, shake them out. They're not giving them back that. They're going to at least bring them to some area of loss they might have been able to hold to, but they're not taking them back to their break even. They manipulated that area. So they usually just test the body of the candle that manipulated the area. They don't test the wick or go below the bottom of the wick, because that's the area they use to shake people out. Yeah, I have a friend that only trades based on ISR confirmations or divergence. They called me sometime. They wait long time to make a good trade, but it's a lot of money to trade left. Behind in between. Yeah, I mean, you know, like people utilize their own systems and they have their own risk involved, and they make money, yes, but we're talking about like being able to make, you know, an obscene amount of money and also be very, very accurate with it. So you see, guys, see how I said we tapped into a bullish area and we would end up going bullish? I said that all of this up here was already mitigated, so we would end up going through the area. And I said that there could be a potential rejection here back down, but then we could still end up just taking the high above. So you would just look for the rejection there, you know, at this area, and it can just be like a momentary rejection, something quick, something short, you know, and then you can get a run of the high after. But it's all because we tapped into the bullish area responsible for the structural break. So that's how we understand that. So if we knew that and we saw this pushing up, this could have been a scalp on a New York session, just taking that little short move there, could be like 50, 60 pips. You know, just understanding that, oh, we're about to run this whole area because all of this is mitigated already. Lunch meat right here. You know, so that's like noticing those things to the side and finding ways to you like stay out of certain S&D zones comes from utilizing these swing points. Because most people, you might have somebody who has this S&D zone here. Why are we not using this S&D zone here? Because if you move it down to where this swing is here, price already mitigated it at this candle here. We already got mitigated. This swing already got mitigated. So when price comes back up here, most dummies are waiting here for an order block to be tapped into and price shifts down, but it's the move that they're coming back to. Shifted down, came back up, tapped into it, left. This whole swing is mitigated. No matter if this order block is up here unmitigated, the swing is mitigated already. So you know price is going past this area. And then we end up taking the highs. These are equal highs right here. Equal highs get ran later. Equal highs run the low, yes, but when it returns to it, it runs it. Based on what area of structure it's in. So we run this high, we tap up into, this is the second tap of an imbalance to the left. So we all know that this is usually just a retracement back down, and then we go through the area. So now noticing that we're rejecting from here, we know that it's just a retracement down, maybe into some imbalance here, maybe into some S&D that's down here, but then we know we're going to trade higher because this is just the second tap of an imbalance to the left, and it already took out the high of the area here. So we get the retracement down, then we come back up above the area, and do we get rejected from an imbalance here, right here? Maybe, who knows? We'll see what price does when it gets up there. But we have it, we're pegging for it to run this high. But if it doesn't run this high, that's okay. We'll adjust our bias. And that's how, you know, like this all kind of works together, you know, for everybody to kind of understand. I mean, I hope you guys, you know, holy effing Esmond. Yeah, I see some of you guys are understanding, you know, what I'm saying right now. Let me see. Oh, Akeem said he wants to touch on that example when I'm done. Anytime this happens, is price always going to take out the highs that were created? It just depends. I mean, if we have this low put in and we're breaking structure to the top side, if price doesn't take out this high here and we get a rejection from up here, the rejection is usually like, you know, you'll see it like this. We get a rejection out of there and you see us heading back down. If we're heading back down and we don't like create a flip here, if we don't create that flip here and begin to wake up, make our way back up, this is being ran. And oftentimes this will get ran coming back down to this area. Oftentimes this will get ran because it would be a weak low if failed to put in a new high. This is the lowest point here, and price is banking on this point to be strong enough to deliver us from EVA. No, just kidding. Deliver us into a new high. And we would end up delivering, and this would validate this low right here. But if we get caught up here and we begin to short from the area and we break structural lows on this trend, we break structural lows. If we break structural lows, you better believe that we would be coming back down to liquidate the area and continue lower. But when you back test this and you see it enough, you would be able to make certain decisions in real time on how you can engage into the market and what system based on your personality can also, you know, like create that.